When the world feels uncertain, people run toward gold. Wars, inflation, banking fears, currency doubts, market crashes, political chaos. Gold has always had a special place in the human imagination. It does not need electricity. It does not depend on a government promise. It has survived empires, currencies, banking crises, and thousands of years of financial change. So when gold prices explode, people ask the same question again. Is gold protecting us? Or is gold becoming a bubble? That question matters because gold is not like a normal investment. A company can grow earnings. A bond can pay interest. A property can produce rent. But gold does not work, build, or innovate. It simply exists. And that is exactly why people love it. Gold is valuable because people believe it is valuable, because it is scarce, durable, accepted globally, and emotionally powerful. In calm times, critics call gold old-fashioned. In crisis times, those same critics watch the price climb. The first reason gold rises is fear. When investors worry about inflation, war, debt, or banking instability, they look for assets that feel outside the normal system. Gold becomes a kind of financial shelter. People do not buy gold because it promises a business plan. They buy it because they do not fully trust the business plan of the world. That is the safe haven argument. If currencies lose purchasing power, gold may hold value. If governments print too much money, gold cannot be printed. If markets crash, gold may behave differently from stocks. If geopolitical tension rises, gold becomes a panic asset. This is why central banks also buy gold. When countries want to diversify reserves or reduce dependence on another nation's currency, gold becomes attractive. It has no CEO. It has no central bank. It cannot be sanctioned in the same way digital money can. So gold is not just jewelry. It is power, insurance, and distrust in physical form. But that does not mean gold is always a good buy. The second side of the story is the bubble argument. When any asset rises very fast, emotion enters the market. People see headlines. They see record highs. They hear friends talking. They fear missing out. Suddenly, the reason to buy changes. At first, people buy gold for protection. Then people buy gold because it is going up. That is when danger begins. A safe haven asset can still become overpriced if too many people rush in at the same time. Gold does not have cash flow, so it is hard to say what the correct price is. A stock can be compared to earnings. A property can be compared to rent. Gold is compared mostly to fear, inflation, real interest rates, currency confidence, and investor psychology. That makes gold powerful, but also unpredictable. The third factor is interest rates. Gold does not pay interest. So when interest rates are high, investors can earn money from bonds or savings products instead. That can make gold less attractive. But if people believe interest rates will fall, or if they believe inflation will remain a threat, gold can become attractive again. This is why gold often reacts strongly to central bank signals. One speech, one inflation report, one rate decision, and the gold market can move quickly. The fourth factor is the dollar. Gold is often priced in dollars. When the dollar weakens, gold can look cheaper to foreign buyers and may rise. When the dollar strengthens, gold can face pressure. So gold is not only about gold, it is about trust in money itself. The fifth factor is culture. In many parts of the world, gold is not just an investment. It is savings, status, marriage tradition, family security, and emergency wealth. In India, China, the Middle East, and many other regions, gold has a place in daily financial culture that Western investors sometimes underestimate. This gives gold demand a global base, but even cultural demand can slow when prices rise too fast. If gold becomes too expensive, jewelry buyers step back. If volatility becomes extreme, investors hesitate. If the price feels disconnected from reality, people wait. That is why gold can be both loved and feared at the same time. So is gold a safe haven or a bubble? The honest answer is it can be both, depending on why you buy it. If someone buys gold as a small part of a long-term safety strategy, it can act like insurance. But if someone buys gold only because headlines say it is exploding, they may be chasing momentum. Insurance is planned. FOMO is emotional. The asset may be the same, but the behavior is different. That is the key lesson. Gold can protect people from certain risks, but it cannot protect people from bad timing, panic buying, or unrealistic expectations. It is not a magic solution. It will not pay your rent. It will not generate monthly income. It will not guarantee safety in every crash, and it can fall sharply when markets change. But gold still matters because it reveals something about the world. When gold rises aggressively, it often means people are nervous about inflation, nervous about debt, nervous about war, nervous about banks, nervous about the value of paper money. So the real story is not only gold going up, the real story is trust going down. That is why gold captures attention. It is not just a metal, it is a mirror. And when the price explodes, the mirror is telling us that a lot of people are no longer fully comfortable with the system they live in. Maybe gold is warning us. Maybe gold is being overhyped. Maybe it is both. But one thing is clear. When fear becomes expensive, gold is usually the receipt. There is also a psychological reason gold gets so much attention. Most financial assets are abstract. A stock is a claim on a company. A bond is a promise to pay. A bank balance is a number inside a system. Even a currency is valuable because people agree to trust it. Gold feels different. You can hold it. You can see it. It has weight. In a world where finance often feels invisible and complicated, gold feels simple. That simplicity gives it emotional power, but emotional power can be dangerous in markets. When people are afraid, they sometimes stop asking whether the price makes sense. They only ask whether they feel safer owning it. That is when a safe asset can become a crowded trade. A person buying gold for long-term insurance is thinking differently from a person buying gold because the chart is going straight up. The first person is buying protection. The second person may be buying excitement disguised as safety. That difference matters. Gold can protect against some risks, but it cannot solve every problem. It does not produce income. It does not pay dividends. It does not build a business. And if someone buys at the wrong moment, even a safe haven asset can create painful losses. So the real question is not simply, should people buy gold? The better question is, why are people buying it right now? If the answer is fear, gold may be a warning sign. If the answer is greed, gold may be becoming the very thing investors are trying to avoid, another bubble. And in the end, finance is not just about numbers on a screen. It is about the choices we make, the systems we live in, and the future we are trying to protect. If this video helped you see money a little differently, subscribe to the channel for more clear and honest finance breakdowns. Thanks for watching.